Hello and welcome to Domicile Corporate Services podcast series Advancing Vietnam with me, Vlad Savin and Matthew Lowry. Throughout the following episodes, we'll look into answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? And last but not least, we will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. In this episode, I'm discussing with Matthew Lowry, Managing Partner at Domicile Corporate Services, about the most common structures foreign investors use when entering Vietnam, looking at the most appropriate investment vehicles, relevant operating structures, responsibilities and requirements for key representatives of foreign-owned businesses in Vietnam. Matthew, welcome to our 7th episode of Advancing Vietnam podcast series. Glad to have you here.
Thank you, Vlad. I look forward to discussing more about the most common corporate structures used by foreign investors, and also we'll go through the pros and cons that people should be aware of when putting a market entry strategy into place.
Indeed, we often see investors seeking to expand in Vietnam who make critical decisions based on misinformation or unclear advice, which are not in line with their business goals and operational scope in country. Let's see if we can bring some clarity into the market entry process. And before we go into the company structures, can you share a few details about the core investment models used for entering the Vietnamese market, looking at direct and indirect investments? And can you explain what these mean from your experience working with international investors?
Okay, so before we look at actual the physical structures behind there, I think you're right. This direct, indirect, and the general model is important to touch on. So you break down an investment into Vietnam into this indirect and direct. An indirect is a minority investment. Often share market might be minority, or it's a small position in a company. And from a cash perspective, you actually bring that through a specific bank account that you have to open up called indirect investment capital account, versus a direct investment where you are taking a majority position, maybe 100% ownership, it may be a significant role, and then that actually comes through a direct investment capital account. They're specific bank accounts addressing whether it's a minority indirect or a majority direct position. And that comes down to trying to make sure that people have the right mindset and right understanding, but also direct does have a different layer of approvals. The foreign approval process is quite different for most direct investments than indirect.
And when investing in Vietnam, it's critical to understand the available corporate structures and the particulars for each of these vehicles. Can you explain what are the main company forms in Vietnam and how should investors choose one over another?
Okay, so from a form of investment, you've got this a company. You can have a limited liability company. You can have a joint stock company. So limited liability company is what it says. It's limited. It's basically a private company. So depending which market you come from, it's designed as a private vehicle. A joint stock company is a public vehicle. Minimum 3 shareholders for a joint stock company, and limited liability company has 1 shareholder. But you also have the opportunity to do in law a partnership, which is not as functionally common and possible for a foreign investor, but theoretically it's there. But you do have these other processes. So you have a representative office, which is used, and there are limitations, and I think we'll talk about that further. You've got branches, and you've also got within that, you've got other options like business corporation contracts. Now, one of the things when particularly looking at the companies in investments, you've got this idea of a common discussion of joint ventures. So there was in previous laws, there was this reference to joint ventures. Now, a joint venture in the context of how it's used in Vietnam actually refers just to a joint investment. So a joint venture with a foreign and local means 2 shareholders, two companies effectively with a shareholders agreement about their investment. So a joint venture is not a common law joint venture, and that's more akin to what Vietnam calls a business cooperation contract, and again we'll touch on that later. But I don't want listeners to feel that when they hear the word joint venture, it is a joint venture in the common sense. It is simply just a joint investment into a company, be it a LLC, JSC, whatever, but the use of that word has been used differently to what inbound investors would often assume it means.
What are the key characteristics of limited liability companies, and what would be the main differences between a single member LLC and a multi-member LLC? Meaning, does the multiple member LLC have additional benefits from a statutory or compliance perspective?
Yeah, so going through LLCs in particular, but which company you choose, and you asked that before, and I'll answer it in pieces as we go through. So a limited liability company can have a single or it can have multiple investors, and up to 50 investors. And the difference between a single member is that if it is an individual who is that single member, is almost treated as a sole trader as with an incorporated structure, in that the company cannot employ that individual, and that individual can't take a salary. There's no tax deductions for their costs. They are just, the profits are theirs to take. And that's when there's an individual who's a sole shareholder. If the sole owner is a kind of corporate, it's just the same as multi-member company. Now, just on that, so a limited liability company doesn't have shares. It has percentage of capital contributed. So if I put $10,000 in and you put $10,000 later in the company, we would own 50-50. But if it was a joint stock company, it's based on shares. So if I paid $10,000 for 10 shares and you paid $10,000 for 5 shares, that would mean I'd own 2/3, you'd own 1/3, regardless, we paid the same. But that doesn't exist for an LLC. So LLC is percentage of capital contributed. And that can cause issues with structuring. So quite commonly, an LLC will be used for most market entries, controlled, 100% owned, shareholder agreement structures. But if you're raising capital or you're going broadly, a joint stock company can have benefits because you can play with classes, and you can also raise capital at different price points where it's not as easy to do so in an LLC. But the LLC is quite a simple structure. So from when you're looking at LLC, you can have a committee sitting there representing the shareholders. It can be just a chairman or a shareholders committee. It's very basic when it comes to requirements for meetings and obligations. You can have more strict if your charter details, but it's fundamentally a very basic, simple structure to operate from a company secretarial perspective.
And what about joint stock companies you mentioned before? What are the legal provisions for these type of entities, and when should investors take advantage of this market entry model?
Yeah, so the joint stock company is a public structure. So it has shares. You can have, provided you have at least 3 shareholders, there is an unlimited upper end of that, where a LLC is only 50 maximum shareholders, and I think only 20 of them can ever be listed on the ownership documents issued by the authorities. One's designed for private, one is for public. So the joint stock company does have additional layers of compliance attaching to it. So when an LLC is quite a compliance light from a company secretarial perspective, AGMs, those sort of things are per your charter. You do have a different structure for a joint stock company, whereby you will have a board of management, but you'll also have an inspection committee, and you'll have various obligations with meetings, with committees, and with statutory obligations that you can do, and how the shareholders call meetings. The process for doing that is much more formalised, as you'd expect for a public company structure. So the pros and cons of doing it: LLCs are simple, but you don't have shares, so you can't play around with as easily benefits of share categories. Joint stock company, you can have a lot of more flexibility, and you can issue different classes and rights, etc. But when I say that, you still have, Vietnam has significant limitations on classes. So you can do preference shares, ordinary shares, you can do dividend or no dividend, voting, non-voting. You don't have many options to play around with those classes. So it's not like in some jurisdictions you can be really creative. You can be a little bit creative here, but not considerably. So Vietnam is still much more controlled than some markets would be on the structural side of things.
I understand. Matthew, we both have encountered investments that have deep misunderstandings regarding representative offices in Vietnam, their operational scope, and their structural limitations from a commercial standpoint. Can you explain more about the rep office in Vietnam and how do they work?
Yeah, so after limited liability companies and joint stock companies, representative office is the next most common foreign investment form. So a representative office is designed under current laws as a liaison office, as a research office, as an opportunity for a foreign enterprise to enter Vietnam, employ people, have a point of presence, and research and understand. Historically, representative officers were allowed to support commercial contracts from the parent, but that was removed a number of years ago because there was a lot of people taking advantage of that and realistically running a business through representative office. That is not the intention, and the idea is that there's a point of presence in country and it's not to support, and it's prohibited from supporting commercial operations. So once there are commercial operations in country, you may need to use a different model. People often come into the market with rep office and then establish a company later once there's a commercial basis for it, or keep both going. One may be there as a liaison, one may be there as a commercial. You've got to be careful that you can't have the same person heading both operations if you take that path, but it is a lighter cost option. It's actually more complicated to set up a rep office than a company, but on an ongoing basis, it's a much lighter option. It doesn't have tax obligations. It doesn't have ongoing reporting obligations to any similar extent to what a company has. So it is a light option for entry.
Another common type of corporate structure is the branch, which is dependent unit of a foreign entity. When should branches be established, and in which cases do they make sense for foreign investors?
Yeah, so branches rarely make sense. So branches, the requirement for a branch, like a rep office, you must have been established 1 year. A branch, you must have been established for at least 5 years. And so even the law has branch discussions in it, and it is often in documents, including ours, as an option. It isn't an option in practice for most. It's an option almost a requirement for banks and other certain financial institutions to enter the market. So a lot of your foreign banks in Vietnam are actually branches. But outside of the financial sector, there is limited reasons why you'd ever go down a branch. They're costly, they're difficult to establish, they're much more cumbersome. And I think in almost every situation other than those financial institutions, you'd come back to that a LLC or a JSC company is more beneficial. It is cumbersome, and it's not something I've actually personally ever finally recommended after going through the options for market entry for businesses.
Looking at company positions, what are the legal statutory positions in a Vietnamese company, and how do these differ significantly depending on the type of entity or the market entry structure?
So your basic core is that you've got a legal representative representing the Vietnamese company. So a Vietnamese company doesn't have civil capacity in its own right. It's not an individual, it's not a person in Vietnamese law. It requires the legal representative to fulfill that capacity. So any documents, anything entered by the company is the legal representative on behalf of the company, bank accounts, buying assets, etc. So that legal representative, and you need at least one of them. You can have multiple, but one of them must be resident in Vietnam. Not about nationality, it's about residency. You then would need a general director, who is your operational head. They run the business. The legal representative and the general director can be the same person, but the general director is generally the person who runs the business. The legal representative is a person that holds the structural control. And then you can have deputy general directors, which are delegated authorities for various roles, responsibilities, head of finance, head of commercial operations, head of human resources, whatever that might be. Your chief accountant is another position. Now, the chief accountant position is almost replacing in some ways the company secretary in other countries. There's no company secretary role, so the chief accountant is the government liaison. They sign all the taxation and the accounting documents. They also take responsibility for statutory lodgements as they exist. So all companies have those. You will have, depending upon what you have, so joint stock company and potentially limited liability if you set it up, will have different committees. So you've got things from the shareholder side, so you have the members council or the shareholders council. You'll have investment inspection committees, and you'll have a governance process. So that you may end up having in a joint stock companies 2 to 3 layers of governance. In an LLC, you might have 2 layers of governance. That said, if you're a single investor from abroad coming into Vietnam, you would normally have a legal rep general director, potentially the same person, a chief accountant, and you'd often have a chairman for the members, and that chairman represents the foreign investor. That's the simplest and that's the most common way that a single 100% foreign-owned company is structured.
I see. Do enterprises in Vietnam have a term attached to the investment project, which was initially committed in the application forms of the company registration process?
Yeah, so companies have a life. The law says that a company cannot be more than 50 years, but they can be extended to 70s in certain circumstances in very specific cases. Now, you can extend. Some companies, depending upon their sectors, get a lesser life. If you're an employment agency registering as an employer of choice, registering for other companies as their labour hire organisation, you might have a 5-year limitation on your licence. But by default, the standard is 50 years. You can renew, and it's a new application to renew. So it doesn't automatically end, but it does have a finite life. A representative office is a finite life of 5 years. You have to renew it every 5 years. So it does depend upon your business sectors and business lines, but most cases it's 50 years or thereabouts.
One last question. You mentioned before about public-private partnerships. Investors can also invest in Vietnam using business cooperation contracts and public-private partnerships as well. In which industries or cases would you recommend this as a viable option?
PPPs are very much infrastructure focused, and there's specific laws. There's just a new set of laws that have been put out recently to try to foster that, because there's always been the issue of where's the benefit lie, who's taking the risks, where do they sit. So PPPs are large infrastructure and they're negotiated with the government. They are significant points, and there's been evidence of ones that have worked and evidence of ones that have been more difficult. A BCC is a private arrangement. So that is the common law joint venture. It is two parties coming together. I use the example, and it's probably not applicable in Vietnam, but I use the example if someone owns a big truck and someone owns a mine. And so say, okay, you bring the truck, you can use the mine, I'll take 40% of the proceeds, you take 60%. And at the end of the day, we enter the project, we walk away, you keep your truck, I keep the mine, and we split the difference. That exact concept is what a BCC is for. So the business cooperation contract is various parties coming together in an unincorporated venture to undertake and share the proceeds. With a BCC, one party takes the lead. They actually operate, they'll effectively do the registrations. It may need a foreign investment approval if the foreign investors are involved, but it is not a corporate structure in its own right. So there are provisions for one of those parties to be that structure as necessary. So the BCC really comes down to whether it justifies a company in its own right, or whether it is parties doing things together that will then separate later on without having to contribute those assets into a company itself.
Thank you for your insights on these structural matters, Matthew. Unfortunately, our time is up this time, and looking forward to our next podcast.
You're very welcome, Vlad. I look forward to it as well.
Choosing the correct investment in corporate structure when entering Vietnam is a crucial step for international investors. And we always recommend a thorough assessment, not just of the business and commercial environment, but of the corporate and compliance investment structure as well, ensuring an efficient vehicle that is able to consistently create growth and shareholder value. Many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on domicilecs.com. And if you want to reach out to us for any additional details, feel free to contact myself or Matthew on LinkedIn or through the website contact details.